This presentation looks at the resource audit using the 9M's framework. In order to assess the strength of the resources available to an organisation, a framework known as the 9M's can be used. This is not a specific theory as such, but is a useful mechanism to provide a framework that covers every aspect of an organisation. The men and women aspect includes anything to do with human resources. It's not just about how many people are employed, but whether they have the right skill set and experience. It raises questions such as whether the recruitment and retention strategies are working, or whether the organisation is undertaking sufficient staff development to keep the skill base current and the staff motivated with a high morale. It is important to bear in mind that an organisation obtains its human resources from its task environment, so there is a strong link between the resources and environmental trends. Certain industries require certain skills, so they'd be monitoring the environment to look at the availability of the skill set in the future. The element of management is not just about whether the organisation has the right management team, but does the organisation have an appropriate management structure? That is it centralised or decentralised, and is that appropriate for the environment in which it's operating? Linking this to the human resources aspect, the men and women, a review of the skill base within the senior management team can be included to ascertain whether the management has the correct skill set or mix of skills to cope with future strategies. The money aspect is not just about how much money the organisation has now, but the organisation's ability to raise sufficient finance in the future to finance the chosen strategies. For example, what does the balance sheet look like? What are the current levels of gearing? Does it have sufficient assets for security, and so on? This also serves to illustrate that elements are not to be viewed in isolation, as the asset base, considered later under machinery, can have an impact on the future finances, either as a source of security or the need to finance future replacement assets. Makeup refers to the organisation's structure and culture. The question being posed relates to whether the organisation has the right structure and culture to implement successfully the chosen strategy given the changes in the environment. For example, a more dynamic and complex environment may require a shift to a more flexible and decentralised organisation structure, giving greater autonomy to business units in order to facilitate a speedy response to competitor actions. The machinery heading refers to all assets and includes reviewing aspects such as the age of the assets, whether the organisation has the finance to replace them when required, reviewing whether the technology being utilised is up to date, or is it putting the organisation at a disadvantage. The asset value can also be considered under this heading with a strong link to the element of money. For example, organisations in high street retailing or property management would be very interested in what is happening to the value of the asset base. The methods aspect refers to the way of working. It's the procedures and the processes that the organisation undertakes. It asks questions such as whether they could be done more effectively or efficiently. This could include anything to do with manufacturing, design, administration, customer services, in fact any activity undertaken by the organisation. And what we're looking for is, could they be improved in any way? What are the critical activities? How will this impact on the operations of the organisation in the future? Techniques such as benchmarking or analysis of the value system could be utilised to explore if the organisation's performance can be improved in any way. The markets heading facilitates a review of the markets in which the organisation currently operates or is planning to enter in the future, and this could mean withdrawing from markets as well as expanding into new ones. Techniques such as a product life cycle are useful, as organisations need to assess whereabouts their products are within their life cycle, and this illustrates nicely the link to environmental analysis. Things such as social trends, perhaps a change from voice to text communications, political factors, government setting targets to ban the sale of fossil fuel vehicles, or legal restrictions and increased regulations on fire-resistant materials, or environmental factors, the increased pressure we see from consumer groups to enhance the recyclability of products. All of these potentially impact on the product mix and hence the product life cycle. Customer analysis can be considered under this heading, as not all customers provide the same level of profitability due to the different demands placed on the organisation's resources, which results in different levels of costs to serve, and hence profitability of different customers and customer segments. The materials heading includes an evaluation of supplier relationships, as well as things like changes in the materials or sources of materials that are used. Within supplier evaluation, aspects such as reliability, quality, cost, and even location relative to supply can be evaluated. And do current suppliers have the capacity to grow with the organisation? If not, then alternative suppliers need to be sought, or the possibility of dual sourcing needs to be considered. The heading of management information encompasses reviewing the capability of the systems and essentially asks the question, do they provide the information to managers required to manage the business and to develop, implement, evaluate and monitor strategies? In fact, many organisations find that they are still relying on the information systems and technology installed 10 years ago, but that the business has changed. Consequently, the managers do not have access to the information they need to run the business as it is now. Information systems develop entropy over time and become less useful unless the information provided keeps pace with the business as it grows, develops and changes in response to the environment. Legacy systems, including the financial systems, have often developed in a piecemeal fashion, perhaps by implementing workarounds in order to cope with changes, only to find that the lack of integration increases inefficiencies such that the cost of providing information becomes expensive and prohibitive, and therefore organisations need to make sure that they're monitoring the degree of integration required and actually achieved by systems development. This video is part of a series of short videos that explain specific aspects of the strategic management framework and cover some of the strategy models that can be used in the analysis, formulation, implementation and review and control of strategy and the role of the management accountant. The presentation is provided as part of the support materials for the book Management Accounting in Support of Strategy by Graham S. Pitcher and published by Business Expert Press.